Welcome to the Deep Dive. Today, we're tackling a subject that can feel pretty complex,
Yeah.
the Federal Reserve System.
Yeah, definitely one of those topics.
Our source material for this is the book and the Fed, which, I mean, the title kind of gives it away, right? It proposes some pretty big changes.
Huge changes, yeah.
We know looking into the Fed can feel a bit overwhelming, like you're lost in economic jargon.
Mm-hmm.
So our goal today is really to pull out the key insights from this book, understand the author's view on where the Fed came from, what they think it really does.
The criticisms and, what they suggest instead.
Exactly. And this isn't just a casual take, is it?
No, not at all. The author's been studying this, speaking about it for, over 30 years.
Yeah.
And the Fed is a fundamental challenge.
And it's an argument that's gained some traction, especially lately.
It really has, particularly after economic crises. People start questioning things. So yeah, it's a viewpoint with some real momentum behind it.
Okay, so let's unpack it. From the author's perspective, where do we even begin trying to understand the Fed?
Well, interestingly, the author suggests you got to do your own homework first.
Oh, really?
Yeah, read the books, pamphlets, listen to lectures, even look at the Fed's own comic books they apparently put out.
Huh. Okay. And what are the usual reasons given for the Fed's existence? The standard story?
The standard story, according to the book, is that the Fed is there to, stabilize the economy, keep inflation in check,
Right.
make sure banks are solvent, regulate the whole financial system. That's the textbook version.
But the author clearly doesn't buy that. What's their core disagreement?
It boils down to one thing, really. What they see as the Fed's unique, pretty scary power.
Which is?
The power to create money. Just, poof, new money.
Not just manage existing money.
No, create it. And the author argues this very power undermines all those things it's supposed to do. Stability, controlling inflation, all that. In fact, that's the whole root of the End the Fed movement. It's a slogan from rallies, and the book's title. So the key insight is this power to create money from nothing is the fundamental problem.
Okay, this is where it gets really fascinating. This idea of creating money. How does the author say that works? And what are the dangers they point to?
They explain it like this. When the Fed creates new money, it basically bumps up the reserves banks have.
Right.
This new cash just sits there, waiting. And the big worry, the danger the author sees, is what happens when banks feel it's safe to lend again.
All that new money floods out.
Exactly. It could pour into the economy and cause, massive price increases, inflation like we haven't seen in maybe generations.
And the book points to a historical example, a pretty extreme one.
Yeah, they bring up the Weimar Republic in Germany back in the 1920s, hyperinflation.
Where money became worthless almost overnight.
Precisely. The central bank just kept printing money, and it destroyed the currency's value. Now, lots of people say, oh, that can never happen here. But the author uses it as a stark warning. This is what can happen with unchecked money creation.
And this ties into a basic problem the author sees with banks themselves.
It does. The author argues there's a conflict. Banks do two different things, right? They store your money safely, offer services like a warehouse, you pay a fee.
Okay, safekeeping.
But then they also do lending, investing money, taking risks to get a return.
Right, very different functions.
And the author thinks these two things, warehousing and lending, have become dangerously mixed up. They should be more separate.
Got it. Let's rewind a bit. What's the historical backdrop here? How did we even get to the point where the Fed was created?
Well, the book touches on the Civil War, which saw a lot of inflation through government printing money.
Okay.
Then came deflation afterwards, which created this push for stability, leading eventually to the gold standard.
Ah, the gold standard.
But the author argues even that wasn't perfect. You had fractional reserves banks holding only a fraction of deposits.
Like the coat check example you mentioned. More tickets than coats.
Exactly like that. More claims on gold than actual gold. Plus, regulations that the author says reduced competition between banks, so it had built-in weaknesses.
So these weaknesses created an opportunity for the idea of a central bank.
Precisely. People started thinking maybe a central body could manage things better. Tweak interest rates, manage gold flows, bail out banks if they got into trouble.
And powerful interests started pushing for this.
Oh, yeah. Financial groups saw benefits for themselves, started lobbying, public discussions happened.
Which leads us to that very famous secret meeting, Jekyll Island.
That's the one. November 1910. Super secretive meeting at the Jekyll Island Club, this resort off Georgia, partly owned by J.P. Morgan himself.
Wow.
They literally told the press they were going duck hunting to keep it quiet.
So who was there? This duck hunting trip.
Not hunters. It was Senator Nelson Aldrich, big ties to the Rockefellers, Henry Davison from J.P. Morgan, Paul Warburg, a banker pushing hard for a U.S. central bank, Frank Vanderlip from National City Bank, and A. Piet Andrew, Treasury official, also involved with the National Monetary Commission.
That is a serious concentration of financial and political power. In secret. What's the author's take on this meeting?
The author sees it as basically the moment where these powerful bankers and government figures got together to design a system that would benefit them.
And economists were brought in later.
In the author's view, yeah. To give it a veneer of scientific legitimacy, they argue this pattern special interest shaping policy, justified by experts, has basically continued ever since.
And the structure they came up with. The 12 regional banks.
According to the author, that decentralized look, mostly for show.
To hide the cartel.
Essentially, yeah. To make it look less centralized than it really was. The full plan went to the National Monetary Commission in 1911. Then came the PR Blitz.
A big campaign.
Huge newspaper editorials, these supposedly grassroots citizens groups that were actually bank-funded, endorsements from trade groups, all orchestrated to build support.
They really worked to sell it?
They even tried hard to make it look bipartisan to get it through Congress.
Okay, let's fast forward. What impact does the book say the Fed has had on, say, the dollar in your pocket?
Ooh, this is stark. The author points out the massive drop in the dollar's purchasing power since 1913 when the Fed started.
How bad is it?
What cost $1 back then costs around $21 now.
Wow.
Put another way, the dollar's lost like over 95% of its value. The author basically calls this ongoing inflation a kind of theft from ordinary people.
And how does gold stack up over that same time?
That's the contrast the author makes. Using data from the American Institute for Economic Research, they show gold has pretty much held its purchasing power, unlike the dollar, controlled by the central bank.
What about the Fed's other big claim preventing panics, smoothing out the economy?
The author just lists them out. Recession after recession, documented by the official body, the National Bureau of Economic Research, since the Fed was created.
So much for ending panics.
Exactly. The author argues the record just doesn't support the claim that the Fed stabilized the business cycle.
Now, there's always confusion. Is the Fed private? Is it government? How does the author define it?
Yeah, that confuses a lot of people. The author says it's neither, strictly speaking. It's a public-private partnership.
How does that work?
The big banks are the owners, technically. They hold shares in the regional feds, but the government appoints the top people, the board of governors, who make the key decisions.
So a hybrid.
A hybrid, yeah. And the author's conclusion is that this structure combines the worst of both worlds, corporate cronyism and government inefficiency, and it ultimately hurts American prosperity.
Let's shift gears a bit and get into the author's own story. What experiences shaped this critical view?
Well, the interest started young. Childhood, during the end of the Depression, World War II rationing.
Tough times.
Definitely. Came from a family that valued thrift, saving. So even a penny had real meaning. And they contrast that with watching pennies lose value later, even the metal changing.
The book has some personal anecdotes, right?
Yeah, really vivid ones. Their father worked in the milk industry, and there's this analogy between watering down milk to sell more volume and the Fed managing the currency, essentially watering down its value.
That's an interesting comparison.
There's also a story about finding a coffee can full of old Indian head pennies. That sparked an early grasp of numismatic value, rarity and condition making a coin worth more than just its face value.
And the war bonds experienced during WWII.
Right. Encouraged to buy them. Very patriotic. But later, the author realized most of the war was paid for by taxes and, crucially, Fed-created inflation.
So the bonds were more about morale.
More a psychological tool, yeah. And there's another great story about a butcher shop during rationing how the free market, even under constraints, found ways around government-created shortages. An early lesson in market solutions.
What about formal education? Any aha moments in economics class?
Oh, yeah. A big one in Econ 101. Learning that most money wasn't cash, but money substitutes.
Like checking accounts.
Exactly. Checkbook credits backed by only fractional reserves. The author initially thought, neat trick, helps the economy move. But it also planted a seed of doubt, like, how solid is this, really? This doubt grew in college in the 50s. Then the big breakthrough was discovering the Austrian economists.
Mises, Hayek, Rothbard.
Those are the names. Their writings provided a whole framework, explanations for this skepticism that had been building.
The book also talks about seeing monetary changes happen in real time, right? Things with coins.
Absolutely. There's a story about a neighbor buying up bags of silver dollars before silver was taken out of coins in '65.
Foreshadowing.
Yeah, and it illustrates Gresham's law, bad money drives out good. The silver coins vanish from circulation. Another doctor used to bring back bags of silver dollars from Vegas casinos, just a reminder of when silver was common money.
But the really seismic shift was Nixon in '71.
August 15th, 1971. Huge. Nixon goes on TV, says the U.S. won't exchange dollars for gold anymore at $35 an ounce.
Slamming the gold window shut.
Effectively, yeah. The author calls it a default on the government's promise. Plus, wage and price controls, an import tariff, all at once.
How did people react?
The stock market liked it initially, but the author stresses the long-term damage of cutting that link to gold. Calls it the third broken promise on gold after Lincoln and FDR.
And FDR's actions earlier are also covered?
Definitely. FDR confiscating gold from citizens in '33, changing its dollar price, setting up the Exchange Stabilization Fund, this sort of off-the-books government fund.
Then the courts went along with it.
The Supreme Court did, even struck down contracts that promised payment in gold. The author sees this as a major power grab, and when the Bretton Woods system finally collapsed in '71.
Which was that post-war system loosely tying the dollar to gold.
Right. When that ended and we went to a pure fiat dollar, the author says, look, the Austrian economists predicted this instability all along.
The author also mentions meeting some Fed chairs personally.
Yeah, from their time in Congress. Interacted with Arthur Burns, William G. Miller, Paul Volcker.
Volcker, the inflation fighter.
Right. Had more extensive talks with him, apparently. And then later, back in Congress again with Greenspan and Bernanke, gave them a direct line to the thinking at the top.
Alan Greenspan seems like a really key figure in the book, especially given his past views.
Oh, absolutely. The author highlights Greenspan's 1966 essay, Gold and Economic Freedom. Really powerful stuff.
What did it argue?
Basically, that without a gold standard, there's no way to protect your savings from being inflated away by the government, and that governments need inflation, so they have to outlaw alternatives like gold.
Strong words. But then he became Fed chair.
Exactly. And the author points out the massive contrast between that essay and Greenspan's actions as Fed chair, including Greenspan later saying, oh, we central bankers are smart enough now, we don't need gold's limits.
There's even a direct exchange from a hearing included, isn't there?
Yeah, from 2000. The author lays out the Austrian view of booms and busts caused by Fed inflation, low rates, and asks Greenspan point blank, where are the Austrians wrong?
And Greenspan's response.
He acknowledges the concerns, admits fiat money can be dangerous, but kind of dismisses any conspiracy. Says central banks have learned their lesson. The author also contrasts Western central banks selling gold with Eastern ones buying it up. Big difference in strategy there.
So despite Greenspan's background, the author remained skeptical about his time at the Fed.
Deeply skeptical. Some libertarians thought maybe Greenspan was still secretly a gold bug working from the inside.
But the author didn't buy that.
No, they figured pragmatism, maybe political pressure, was driving him, not ideology. Points to Greenspan's 2008 testimony during the crisis, where he seemed to walk back some free market beliefs as evidence, though Greenspan did acknowledge knowing Murray Rothbard, the Austrian economist.
Okay, let's pivot to the author's worries about the current state of affairs, the economy, debt, and the Fed's part in it.
Big concerns there. One is the U.S. exporting inflation, because the dollar is the world's reserve currency.
How does that work?
Other countries hold dollars, so when the Fed creates more, some of that inflation gets felt overseas. Also, worries about huge, ongoing current account deficits, basically. Buying way more than we sell. Can that last?
And the core idea of creating wealth by just printing money.
The author fundamentally questions that. Can you really build capital, real wealth, just by creating money and credit out of thin air? They point to things like the MZM money supply figure.
MZM.
Money zero maturity. Basically, really liquid money, cash and checking accounts, money market funds. Seeing that number shoot up is a sign of inflation, the author argues.
What about the idea that a weaker dollar helps exports?
The author sees that as temporary, at best. Maybe a short-term boost, but ultimately it just means higher prices for everyone here. Imports cost more, domestic producers can charge more, it fuels inflation.
Does the author feel the Fed resists changes that might reduce its own influence?
That's definitely the feeling you get. There's an anecdote about Bernanke's reaction when the author suggested ending the Fed would make powerful people irrelevant. Implies a self-preservation instinct.
And Bernanke's helicopter money idea.
The author sees that as incredibly dangerous, just showering the economy with cash. They think it would destroy the dollar.
How does this contrast with other economic schools, like Milton Friedman's?
Well, Friedman advocated a steady, predictable increase in the money supply, monetarism. The author, coming from the Austrian school, wants hard money, ideally gold, not constantly expanding fiat currency. Interestingly, Anna Schwartz, Friedman's collaborator, later criticized Greenspan heavily over the subprime crisis.
The book also includes a story about politics influencing the Fed, involving Arthur Burns and Jimmy Carter.
Yeah, fascinating little historical note. A memo surfaced suggesting Burns, the Fed chair then, might ease up on Carter if he got reappointed.
Wow, did it work?
Apparently not. The courtship failed, Burns wasn't reappointed, the dollar weakened further, and Carter struggled badly with inflation. It just shows the political pressures.
Reagan, too. Any sympathy for gold?
The author says Reagan privately was sympathetic to the gold standard idea, but his advisors were against it, feared the consequences, so he never pushed it.
How does the author view economic crises? Are they opportunities?
They argue crises are seen in two ways. For some, it's a chance to push for more freedom, sound money. But for others,
It's a chance to expand government power.
exactly. Fear makes people accept things they normally wouldn't. More control, more spending. The author believes the interventions caused the crises in the first place, so doing more intervention just makes things worse.
And the people asking for bailouts.
The author points out the hypocrisy. They call opponents ideologues for sticking to principles, but conveniently forget their own free market talk when they need rescuing. It's always about which ideology you follow.
This leads to a moral critique as well, doesn't it?
A very strong one. The author argues a system where a banking monopoly can secretly create money counterfeit, essentially with no real oversight, is just fundamentally immoral.
They bring in biblical references.
Yes, quoting passages about just weights and measures and you shall not steal, framing the Fed's actions as violating basic ethical principles.
The author's own political campaigns seem to have offered insights, too.
Yeah, there's a story from their first run for Congress, meeting George R. Brown, head of Brown and Root Construction, a big Democrat LBJ ally.
Why would he support the author?
Initially because the author opposed unions. That helped them win an unexpected runoff. But once the author's broader views, especially on money and the Fed, became clear,
Support vanished.
completely. It was an early lesson for the author about how business and government partner up. They used to be less cynical, but came to believe this partnership is mostly about enriching special interests.
And the fallout from that partnership.
When it leads to graft, crises, the free market gets blamed, which then justifies more inflation, more government expansion, helping those same interests again. It's a cycle.
The author uses some strong language here, comparing it to fascism.
They warn about a creeping nationalization, where private enterprise exists but is heavily controlled by the state, which they equate to fascism. They contrast it with, say, Truman just issuing an executive order to nationalize steel, more honest maybe.
Than today's bailouts.
Then today's less overt bailouts and takeovers, yeah. The author worries about a lack of principled opposition, even mentions concerns about compulsory national service down the line.
And draws parallels to historical examples.
Yeah, to business leaders in Germany and Italy under fascism who thought they could work with the regimes and stay in control, but ended up totally subservient. The argument is, once you endorse government force in the economy, you open the door to government controlling everything, even leading to militarism.
Shifting to the Constitution, what are the core legal arguments against the Fed in the book?
It centers heavily on the necessary and proper clause.
The elastic clause.
Right. And the Supreme Court case, McCulloch v. Maryland. The author argues that case twisted the Constitution
How so?
by saying Congress could pass any law it deemed necessary and proper to carry out its listed powers, even if that power wasn't explicitly granted. This, the author says, allowed the second bank of the U.S. and later the Fed itself.
So implied powers eroded liberty.
That's the argument, especially over the last century. The author is pretty critical of the Supreme Court overall on money issues.
Not seen as a protector of sound money.
Not at all. Points to the court upholding greenbacks, paper money during the Civil War using similar logic, saying legal tender is just whatever Congress wants it to be.
Ignoring the constitutional mention of gold and silver.
Ignoring gold and silver and the part prohibiting government from emitting bills of credit, which the author equates to paper money. So don't expect the courts to fix this, is the message.
What about transparency, or the lack thereof?
Big issue. The author shares their own experience, asking Bernanke for details on the 2008 bailouts, who got the money.
And the response?
Bernanke apparently refused, said releasing the info would be counterproductive?
Counterproductive to whom?
Exactly. The author sees this as totally unconstitutional, defying oversight, but doubts the courts would force the Fed's hand. They also give props to historical figures like Wright Patman, Henry Gonzalez, Leo McFadden.
Congressmen who pushed for Fed accountability.
Yeah, for decades they warned about the Fed's power and demanded audits. Constant fight for transparency.
The book also tackles the common idea that inflation is just a sign of a healthy economy, right?
Oh yeah, directly challenges that. Argues that blaming a good economy for rising prices is backwards, at least in a fiat money system.
What should happen in a free market?
In a truly free market, a growing productive economy should lead to falling prices. More goods, more efficiency.
So the Fed's solution?
The Fed's solution to rising prices is often to slam the brakes on the economy, reduce demand, cause pain. The author sees this as treating the symptom, not the cause, and the wrong symptom at that.
How does the author frame inflation and debt overall, then? Merely?
As deceitful, unfair, fundamentally corrupt. Higher prices are just the dollar losing value. It's a tax, hitting the poor and middle class hardest.
All benefiting.
Benefiting those who get the new money first. Government, banks, big corporations. It transfers wealth upwards, and it pushes the real cost onto future generations through debt.
And that debt
Is now coming due. The author believes excessive debt like this, national or personal, eventually becomes unpayable. We might be at that point. Globally, it has to be liquidated somehow.
What about just adding more rules, more regulations, SEC, Sarbanes-Oxley type stuff?
The author is really dismissive of that as a solution. Says more rules won't stop bad actors.
Why not?
Because relying on government protection creates moral hazard. People take bigger risks if they think they'll be bailed out. The Fed's easy credit sets the stage for bubbles, government insurance encourages risk, and endless bailouts just reward bad behavior.
So what's the core problem preventing real solutions, in the author's view?
It's a lack of understanding. When things go bad, people often demand more of the same policies that cause the trouble: more spending, more deficits, more rules, more inflation, because they don't grasp the root cause.
Which brings us to the final section. The way out. What is the proposed solution?
It's simple and radical, and the Fed. Just unplug the machine.
Wow.
The author quotes a poem suggesting a debased currency reflects how a society treats its honest people. They look at recent Fed programs, stimulus, bailouts, and see more of the same: bigger government, more dollar debasement, no real benefit.
But wouldn't ending the Fed cause chaos? Destroy the financial system?
The author argues no. The dollar would still exist. Banks, ATMs, electronic payments, all that infrastructure remains.
So what changes?
What changes is that options open up. People could freely use other currencies, gold, silver. Investment would become sounder, less driven by Fed distortions. The digital age makes this even easier, they argue.
Private currencies and payment systems.
Yeah, the author points to how things like gold currencies and private systems thrive online, even with legal hurdles now. Suggests the market will innovate if allowed. Banking would shift too. Focus would have to be on safety and soundness, not relying on Fed backstops.
Is ending the Fed politically feasible?
The author holds out hope for a coalition, mentions a 2008 press conference where candidates from different parties actually called for a full Fed audit, an end to money creation for special interests, and no more bailouts. So maybe the idea isn't totally fringe. So yeah, to wrap it up, this deep dive into End the Fed shows a really fundamental critique. The author hits the Fed's origins, arguing it was self-serving. They challenge its track record, pointing to the dollar's decline, the endless boom-bust cycles.
Right, contrasting promises with results.
Exactly, portraying it as this problematic public-private beast and offering historical, moral, constitutional arguments for just ending it.
And the proposed way out, as we heard, is dismantling it completely. Let the free market handle money and banking. Now, it's crucial for you listening to remember this is one perspective, a deeply researched one, yes, but still one side of a complex debate.
Absolutely. We definitely encourage you to think critically about these arguments, maybe check out the sources mentioned, and for sure look into other viewpoints on the Federal Reserve. It's too important not to.
Which leaves us with a final thought, maybe something for you to chew on. If the power over money is as prone to misuse as this author claims, and the consequences are so vast,
Yeah.
what does that really mean for our economic future, and maybe even more fundamentally, for individual liberty?